I think in order to be successful in this space, you need to get technology right, you need to get finance right, and you also need to get regulatory right. If you kind of boil down all my experiences at SoFi and Brex, and oftentimes you learn the most from things that don't go your way, I think the lessons are around the intersection of those three is what it takes to innovate in this space.
Welcome to High Stakes, the podcast where Web3 meets the real world. I'm your host, Alex Nwaka, co-founder and CEO at Validation Cloud, and former principal at Touchdown Ventures, where I led enterprise SaaS investments. Each week, we sit down with the founders, investors, and institutional leaders pushing the boundaries of blockchain, AI, and infrastructure. If you're navigating regulation, building at scale, or trying to separate noise from signal in emerging tech, you're in the right place. Let's get into it. Welcome back to another episode of High Stakes. I'm Alex Nwaka, and today I'm joined by Michael Tannenbaum, who is the CEO of Figure. Welcome, Michael.
Hi, thanks so much for having me.
Absolutely. So, Michael, maybe for the audience, maybe give them a bit on your background, where you come from and how you made it to Figure.
Sure. Well, I'm originally a New Englander. I'm from Boston. I did a lot of research in college. I went to Columbia. I was studying to be an economist focused on the housing space. And that ended up becoming pretty relevant in my career. I went to work at JP Morgan out of college in kind of regional bank M&A. I worked in a private equity company in San Francisco. And then I went to SoFi, where I started on the capital markets team. SoFi is a large fintech company, one of the largest now. And I kind of worked my way up through that company and ultimately ran the mortgage business, which came back to housing finance. And when I was at SoFi, we were originating lots of assets. And that was kind of the beginning of when blockchain started becoming relevant, just because there was this huge problem of placing all these assets and figuring out where they go and all of the underwriting and the capital markets work that happens and the audits and the validation. So that was kind of the beginning of seeing some of the issues. I left SoFi. I joined a company called Brex really early. I started basically in a kitchen as the first employee, and then that company became really big, and I'm still on the board now. And then I joined Figure a little bit later, actually, probably call it Series D, pre-IPO, and I helped take that company public earlier this year.
Really awesome. And from the fintech background into blockchain, what would you say was if there was a seminal moment that really convinced you that, hey, this is where I want to bet with my time as it relates to blockchain specifically as a technology?
While I was at SoFi, when we started preparing loans for sale and going through the audits that would come into a securitization, I remember staying up really late one night, checking all the credit reports and all these attributes of the loans to confirm that the loan tape, basically the Excel file for the loans actually matched what the source documents were. And I remember thinking, if I'm doing this, then the simply seems like there's probably a better way. And so I didn't start Figure. I invested early. And Mike Cagney, who was the CEO of SoFi and the founder, and then was the founder of Figure, and I stayed in touch. And so I invested in Figure, and I kind of understood what he wanted to do and really understood that opportunity, because Figure at its core is a company focused on the capital markets and blockchain, the intersection of those two. And we are the largest originator of RWA, real world assets. And we put those on a blockchain, and that saves a ton of costs and time in the system. And so that experience at SoFi ended up becoming very relevant for this, and was a seminal moment. I remember that night.
Yep, absolutely. And, you started to, dive into Figure and really the mission and, what set of financial, infrastructure problems it's solving. Maybe for the audience that may not be as familiar with Figure, maybe giving just a very high level, mission, what you guys are solving for today and how you think about that evolving into the future with the mission of the company.
Yeah, so our mission is to bring the capital markets onto blockchain. And in particular, we've started, as I mentioned, in the real world asset, and in our case, largely mortgage space, which is, part of this private credit ecosystem. And what we've done is we've built a origination system, so technology that partners, we have over 200 partners, can use to originate assets, which include mortgages, crypto-backed loans, for example, as well. and they can use that technology. And then with that technology comes a embedded blockchain-based capital market. So when you're unlike the situation at SoFi where we kind of originated assets and then had to sell them, Figure has an embedded technology and capital market together. And that technology and capital market runs on blockchain. And what we've been able to do, for example, in the mortgage space, is take what was a 45-day and $12,000 process and do it in 5 and $1,000. And we can do that because of the automation, the standardization that we bring, and the blockchain technology, which ultimately reduces third-party reviews of these assets. Going back to kind of where I started, we take 80% of the time and cost out of third-party reviews because of the information being standardized and immutably put on a blockchain upfront.
And I'm curious, tying some of your previous fintech experience to your current mission at Figure, was there anything about the experiences you had at either Brex or SoFi that taught you lessons that you're applying to sort of the financial innovation that you're really pushing today at Figure?
Yeah, I think there's lots. I mean, I think the highest level is that in order to innovate in fintech, and I would put blockchain broadly in the category of fintech, there's probably people who would say fintech is a subsidiary of blockchain, but regardless, I think in order to be successful in this space, you need to get technology right, you need to get finance right, and you also need to get regulatory right. If you kind of boil down all of my experiences at SoFi and Brex, and oftentimes you learn the most from things that don't go your way, I think the lessons are around the intersection of those three is what it takes to innovate in this space.
And one of the things you touched on that I think has implications for those different things that you need to get right is what I would call trust and transparency. And so maybe how do you think about building trust as you're building what I would call this sort of foundation to be able to enable that from the different constituencies you just described?
Trust is something that is earned in drips and you can lose it by the bucketful, right? So I think the way that you build trust, and it's often tied to, in financial services, it's tied to brand as well, is kind of getting those customer experiences right, taking things like incidents very seriously, security, compliance. And you, like I said, you kind of earn this over time. And I think also one of the things that I've focused on in all the roles has been partnerships. And partnerships allow you to attach yourself to other brands. And in particular, in financial services, I think that's something that we do really well at Figure, and we also did really well at Brex. When we started Brex, one of the first partnerships we had was with First Republic Bank, which RIP, but had a great brand at that time. And that was a really big validator for a lot of people that were thinking about, can I trust this company? And I look at Figure and, we have 200 partners, including 50% of the top 20 independent mortgage banks, tons of regulated banks and credit unions that partner with us. And I think we're AAA securitization from S&P and Moody's. And so we have a lot of these validating factors that ultimately bring trust to our brand. Of course, there's some irony in this discussion because the whole point of blockchain and what we do is to displace trust with truth, but that's more about the operations of the business. The reality is, and I think this is, something we can get into, but in the crypto and blockchain space, you don't want to be too religious to sacrifice the fact that, you ultimately need customers. And so customers, even if your product doesn't require them to trust you, it doesn't mean that they still don't need to trust you in order to use your product.
And I'm curious, if you were sitting in your old seat at either SoFi or Brex, what would convince you that blockchain-based infrastructure was ready for prime time? And do you believe that it is ready today, and it's really more of a discovery process for the folks that are out there in the institutional realm?
I think ultimately, if I zoom out and kind of try to place myself in a different company, I would say, what does blockchain really do that doesn't already happen today? Why do we need this technology? Is this a technology looking for a problem? Is it a solution looking for a problem? That's probably what I might think. But being specific about Brex, which is a corporate credit card, if someone had said to me when we were starting that company, there's a capital markets rail, an automated underwriting and capital market that comes together, that's on blockchain, that all you have to do is integrate that, and then you can focus on innovation, product experience, marketing. I would have been interested. And I think that if you kind of look at fintech, there's and let's just use the Brex example. There's Brex, there's Ramp, there's Navan, there's Bill.com. All these people are coming up with their own ways of offering a corporate credit card, and they're building out warehouse lines and capital markets. And ultimately, that's pretty inefficient because none of the people that are choosing those products are choosing them because of that reason. They're choosing the software, they're choosing the marketing, they're choosing the brand, they're choosing the rewards. And none of that really ties to that huge amount of financial and underwriting infrastructure that they require. And so I think if something like Figure existed for Brex at the time, we would have been very interested. So that's my rebuttal. That's my rebuttal to myself. That's my skeptical self.
Yes, your rebuttal counterfactual. So you obviously spend a lot of time with major banks, asset managers, regulators, a wide swath of constituencies that really touch the traditional financial markets in different ways. For you, what's the most telling question that comes from that constituency that separates the folks that you would describe as understanding and getting it, and those that still don't?
Yeah, I think blockchain more broadly would be, what's the difference between this and a database? And I think that's because in some ways there isn't that much of a difference, right? Like blockchain is a form of a database. The point is around the permissions and the validation and the mutability and the decentralization of it all. So it's not that the functionality itself is similar, right? But it's the fact that the permissions and the way data moves and the validation and the decentralization of all that I think is valuable. And so I think it's, when you're asking that question, I think it just implies that you're kind of taking a more narrow view. And if you look at technology more broadly, you could ask a similar question about lots of technologies. Like you could say, just using some very basic examples, but like an iPhone is still a phone, right? And so just because it's not like, I just want to call someone, sure, right? Like my point being is like, yes, it stores information, but I think that at least in the context of what Figure does, and you're starting to see this today, I don't know if you've seen any of this, Alex, but there's a lot of issues around double pledging loans, this tricolor bankruptcy. You're sort of seeing a lot of counterfactuals to what happens when you don't use Figure or a version of Figure in the provenance blockchain. And I think that that's a perfect example. Like that information could have been, so just to give context to the listeners, this is a bankruptcy tied to the fact that loans were double pledged to multiple people. And those loans could have existed in a database, but the fact is that database was wrong, right? So it's not about whether or not it's like, yes, there is some functionality of a database, but it's also about the smart contracts and the permissioning, as we've talked about, and the immutability of the data that goes into that database that really moves the needle.
No, it's a great call out, and it really is, an example of, there's not just sort of broader sort of risk controls, right, that are required to get things right in the capital markets. There's also just operational hygiene that sometimes gets missed, to your point, Michael. And again, blockchain creates a really great solution to cleaning up and really like negating the need to even have some of those operations at all. One question I wanted to ask you was around sort of legacy assumptions in finance. Do you see any legacy assumptions in finance that need to, in some ways, go the way of the dodo in order for blockchain-based markets to truly thrive?
I think that there's an assumption that a lot of industry participants have, which is that let's just use underwriting as an example.
Mm-hmm.
I think people look at years of experience and judgment and think when you're doing something like underwriting, and I'm assessing someone on that basis, it's like, how many years of experience do they have? Where did they work previously? There's a lot of these, call it tangential things that influence whether someone views that position, as an example. And the reality is a model-based approach to underwriting makes a lot more sense than looking at someone's years of experience or where they worked previously, which don't directly correlate with their ability to underwrite. And so I think that's kind of a microcosm of a lot of things in financial services, underwriting being very big and obvious, where Figure takes a different approach, right? We underwrite based on bank account cash flows and to a specific model, and that's auditable and can be put on a blockchain. You can't put somebody's taste and preferences on a blockchain, but you can say, this is how we underwrite, this is our approach. And I think more of that standardization is valuable. And you'd think that would be very obvious, but there's a lot of just legacy assumptions and processes that make people focus on things like years of underwriting experience. And from that, you sort of see it's not about getting more and more detailed on the underwriting experience of that person. It's about actually asking the question, why are we even doing it this way?
Yep, absolutely. And, you started to get into, what I would call sort of underwriting and maybe even compliance by design. I'm curious, when you approach, that particular set of things in an environment where in a lot of ways the rules are still being written and policy still being written, how do you manage that where, again, you're sort of building, a system that you also are seeing the rules of the road sort of also, coming into view and being assessed at the same time. So I'm just curious how you've navigated that, and then also what your sense is of everything that's going on related to that.
Yeah, it's an important point because as you evolve as a company, you start to have more to lose and less to gain. And you don't want to fall into that trap of becoming so overly concerned that you can't actually innovate. So when you first start, right, you're like, okay, well, this doesn't work. It doesn't really matter because we don't have anything at all. But as you get bigger, you naturally are going to become more risk averse, which is okay, but you want to push against that too. And so the approach that I've typically taken here is, and honestly, AI tools are a wonder for this, is to really push on the regulation. I think just going back to that underwriting example we just gave, similarly in compliance, there's a lot of suggestions that ultimately boil down to, well, this is how we did it here or there. This is how JP Morgan does it, right? There's a lot of people who think like that. And it's not necessarily bad, but if you're trying to change the status quo, you have to think differently. And so I think getting much closer to the actual regulations and understanding not only what they say, but the context in which they were written is really valuable. And trying to push on something like that is how you bring innovation. And usually that has to come, founder, CEO down. You're not going to really, or somebody acting in that position, right? It's not going to come bottoms up.
And, regulation is a very pernicious thing, right? Because it's very rare that you see it reassessed over time longitudinally. It just sort of like adds, it's like, paper mache, you just kind of keep adding more and more layers and it becomes really complex. I'm curious though, if you were to sort of go back in a time machine and be able to say, let's rethink this one kind of component of financial regulation from a historical context, maybe the one that comes up and feels like, maybe the hardest thing to kind of wrap new legislation or new regulation around, what would that be out of curiosity in your mind?
I would probably say the securities regulation. I mean, securities are working well, but constantly there's just a lot of burden for companies to go public. And just this broad framework around investor education and compliance and sort of what we've seen with the private market. I think there's, so much boom and innovation in the private market that people haven't been exposed to because fundamentally the requirements to be a public company are big. And then also the way that private companies can sell to regular investors is also really limited. And so what's happening is you kind of have those two things working together such that a lot of innovation and wealth creation is not available to a lot of other people, which seems like like a very fundamental problem. I wouldn't say that in my career, that's been the number one problem that I've experienced. I would focus more on things like some of the consumer finance, truth in lending, those type of things that have been more of a nuisance because I think a lot of times you're not, I mean, some parts of the regulation are good, but some parts of the implementation, I think, are not necessarily resulting in outcomes that the designers of the laws wanted. But I think but broadly, when I just look at financial services and the whole US economy and what's not working, I think that there's probably too little availability for the general public to invest in some of the most interesting companies. And there's a reluctance for those companies to go public. And so I think that's a big solution. That said, or that's a big problem. That said, US capital markets are the envy of the world. And so what we're doing is certainly working better here than anywhere else in the world.
Oh, absolutely. Maybe talking a bit more about tokenization and capital markets, since we sort of started to go down that path. We've really seen some significant momentum, I would say, in tokenized treasuries and early moves into private credit. In your opinion, what's the most misunderstood part of sort of this early set of tokenization and capital markets trends that's out there that you think the general public is not fully watching or aware of?
I think tokenization doesn't necessarily mean liquidity. So that's a big thing, is that just because you tokenize something does not make it liquid. And so going back to the question that you just asked about regulation and what are the opportunities, I think if you look at something like Figure, what we've been able to do on the tokenized private credit side, particularly in mortgage, is create a liquid market. Over 60 billion of the real world assets that we originate have traded. And we've brought liquidity into private credit in a space that hasn't historically done so. And we've done that by homogenizing and standardizing it. And so I think that concept is missed by a lot of people, and they're looking to tokenize. Like, honestly, I mean, treasuries are already relatively liquid and standardized. So it's not as valuable, in my opinion, to tokenize them as it is to do something like private credit. And going back to this whole capital markets thing, equities, if you look at the history of them, it used to be much more nowhere near as standardized. And there's like the evolution of the exchanges and all these rules. And yes, there is opportunity. But when I think about where is there more opportunity, I really think private credit is one of the best places, because you have this huge asset class that has many of the same attributes as things like equities or commodities, but it doesn't have that standardization. And that's why Figure is so focused on that space and trying to bring liquidity. We are tokenizing, but we're not just tokenizing for the sake of tokenization.
It's a great call out. And maybe as a next vector for us to move into, because I know this is an area that both we at Validation Cloud, as well as you, are also really passionate about, really this intersection of artificial intelligence and blockchain. And so, we've really started to enter an era here where, to your point, AI can analyze, underwrite, execute transactions autonomously. And I'm curious, like, as you think about the role of blockchain and what it can play, making that world that we're moving into auditable, secure, trustworthy, how you think about the convergence of those two technologies and how important, frankly, blockchain is to making it work.
Yeah, I know I've spent a fair amount of time at underwriting, but I'm going to come back to it because I think it's another great example, which is right now, and it gets back to some of the regulation questions. If you were to use AI in loan underwriting, that would be considered problematic from a regulatory perspective. It would be considered problematic probably from a buyer perspective, because, AI can hallucinate. And at the same time, a black box approach doesn't work. People need to understand exactly what happened. And so I think by basically using a combination of blockchain and AI technology and saying, I'm going to take the process that the AI went through and put that on a blockchain in an immutable way such that I can always come back to that, I think is a great example of a use case, and one that would probably be helpful from not only a secondary market or buying and selling of the loan perspective, but also from a regulatory perspective, where people need to be confident that your AI model is not doing anything to bias against a certain protected class or otherwise. And so I do see that as a very big opportunity. I think another area that's interesting is just if you think about more, but on the payment side of blockchain, another place where besides tokenization, there's been a lot of momentum. On the payment side, when you think about who's going to be doing work and what needing to get paid for work in the AI world, there will be agents that need to do that. And so if you think about an agent that is transacting and is moving money on behalf of itself, right? Not necessarily on behalf of someone else. How do you KYC an agent? How do you tell an agent what to do programmably with money? I mean, programmable money is stablecoin. So I think that you're going to need a new financial services paradigm for not only the KYC and compliance environment, but also for the money movement and programmable money environment. And I think stablecoin and blockchain go together well with AI in that context.
And I'm curious, you talking about, a world where, again, we're going to see a litany of AI agents, right? I think the latest figure I saw on this is that there's something like 250 million agents already out there today. And I think it would be a safe assumption to assume that we're going to have multiple agents per human being on this planet. And
Right.
so I think we're going to rapidly get to, the billions sort of range of AI agents. When you think about just what's going to be required from an infrastructure perspective to be able to enable all of that from a blockchain perspective, where do you see things potentially breaking, just given not only the volume of AI agents that I would predict we're going to have in the next 2 to 3 years, but then also given the fact that those agents are going to transact, way more than any humans ever transacts in a given day, in a given month, right? These are agents that, don't get tired, can transact thousands of times in a second. So just curious how you see this volume metric increase in transaction activity and where that potentially needs to be resolved from an infrastructure perspective in blockchain to enable that.
Yeah, I think it's a great point because we're not quite, and that's where if we want blockchain to disrupt some of the incumbents, particularly in payments, I think this is a really valuable point. And one of the problems that we have is that there's this almost Cambrian explosion of L1s and stablecoins. And so you're not seeing as much migration to winners and kingmaking as you might expect. And so as AI evolves, something that I could imagine happening if that issue isn't addressed is that people that are focused on agentic payments may say, well, there's no natural L1 or stablecoin or set of stablecoins to focus on. So we're going to use, traditional rails and I think that would be suboptimal for all the programmatic money reasons I mentioned. I think also from a compliance and KYC perspective. But at the same time, I think that is one of the bigger problems in the space today is if you want to build on blockchain, that sounds simple, but then what are you building on and which L1, which ecosystem, and new ones keep forming, right? And they have legitimate reasons and they have legitimate projects, but that is definitely something that if I was running one of the agentic commerce ecosystems or projects, I would be concerned about.
Yeah, and the way we look at this as, from a data problem, from a scale perspective, and I describe this to various folks that we speak with on, there's billions of permutations of networks, protocols, and assets that, you need to understand in order to really enable all of this. And that level of, visibility and intelligence is very difficult to get your arms wrapped around. And it's what we've spent a lot of our time focusing on because we think it's important ultimately. And we may get to a place, 2 years down the road where to your point, we start to see consolidation around, a certain set of L1s, a certain set of protocols, a certain number of stablecoins as an example. But I think between here and there, what we're experiencing right now is really a Cambrian explosion. It's a very good term you used across all three of those vectors. It's one really exciting, but it also creates to the point we're making here, a very big and complicated data and intelligence problem as it relates to payments and frankly, just enabling agentic commerce at a broader scale. Michael, I don't know if you want to talk a little bit about you just had an announcement recently on a new AI-powered DSCR loan platform that you all launched, and curious if you want to tell the audience a little bit about that. It seems like a really apropos initiative to maybe talk about here, given that we're talking about this intersection of AI and capital markets in a way that's very relevant.
Yeah, well, DSCR sounds super obscure. Probably no one listening knows what that is, but essentially it stands for debt service covenant ratio. And what it really means is like commercial real estate rather than personal real estate. And so commercial real estate, you're evaluating the property's ability to service the debt. Whereas in a personal real estate, you're evaluating a person's income and ability to service the debt. And so this is kind of a chassis from which we can enter a much broader space, right? We've focused a lot on consumer mortgage, but there's a whole world of single family rental and investment property. And then even beyond that, of just commercial real estate more broadly, think gas stations and dental offices, anything that is not residential real estate, which also includes multifamily properties that are being put out for rent, right? So anything that's not a single family residence, that's a huge market. And I think when you think about Figure and what we're trying to do, going back to our RWA conversation and back to the opportunity, all of these markets should be more standardized. There's a lot, if you think about a loan against a gas station versus in one city versus a loan against a gas station in another city, like they're very similar. There's a very small set of metrics that you would need to know whether you wanted to buy that loan or trade that loan, but they could be done totally differently with physical loan documents and having, no certainty or perfection of lien and being super opaque to the buyer. And we want to standardize every asset class that exists, right? So starting in private credit, but moving on even into places like equities and commodities. So this is a big opportunity.
No, absolutely. And maybe curious as you think about what you're optimizing for in sort of this next cycle that you weren't optimizing for in the last one. Do you have something that comes to mind there that you're thinking about?
Sure. I think it's diversification, because diversification of product. I think we don't know where the problems will come in the next cycle, right? If you look at the most recent, like big private credit cycle was a mortgage problem in 2008. Unlikely that will be the next flavor of problem, because problems tend to rhyme versus repeat. And you're already starting to see some problems in the credit space, more in the auto, and we talked a little bit about that already. In the crypto space, I think there was a lot of problems in the last cycle, which was much more recently, around fraud and kind of people being, if you looked at what happened with, say, Celsius or FTX, right? There was a lot of concerns there, and concerns related to centralization and people taking counterparty risks that they maybe didn't appreciate, which is one of the reasons why on the blockchain side of things, Figure pushes a DeFi-oriented approach. And so, I think you're always trying to learn from what went wrong in the last time, but anticipate through diversification of product, technology, approach, because likely what goes wrong in the future is going to rhyme, but not repeat what happened before.
No, absolutely. And then I'm curious, is there one belief about either fintech or blockchain that you've changed your mind on in the last 2 years?
I think that I didn't appreciate the scale of the opportunity for blockchain beyond payments. I think a lot of people have focused on payments, and there's been also a lot of blockchain for blockchain's sake. But if you go back to my time at SoFi, blockchain for real estate and title and all those types of things, that was actually one of the original thoughts that people had is, imagine if all county records and, was put on a blockchain, it would be a perfect example versus like the title insurance. And so for me, kind of coming back to more the real world use cases has been really interesting, because there haven't, besides Figure, been as much of that. And if you look at even the IPO wave that we've just had, it's largely been companies that help people buy and sell crypto, right? Like all the blockchain companies that have gone public are basically exchanges, and exchanges largely allow people to buy and sell crypto, but they don't necessarily touch the real world in the way that Figure does. And so seeing that opportunity and actually the execution there, which of course I've been a part of, has been very eye-opening.
And then any personal reflections? You mentioned, we've really seen a big IPO sort of pushed by a number of companies in sort of the crypto space. And obviously you've just gone through this with Figure. I'm curious, any personal reflections you have of like that process and getting it catalyzed, anything that was sort of like unique? Because again, this is your second time, going through sort of a public process. Previously did it, at SoFi, but curious when in the CEO role, I always think of that as a little bit of a different, lens and role to be taking as part of the process. So curious, any personal reflections you have on the process and any visibility you could provide there.
Yeah, I think for your audience, it'd be relevant to focus on the SEC comments part of it. I think that requires, if you're going to be in the blockchain space, you're of course going to get more questions. And I think it requires some very concerted effort on behalf of the most senior leadership in the company to make sure you're putting your best foot forward, because oftentimes the people that are working on an IPO, which would be finance team, legal team, investment banks, it's not that they don't know, but it's not the product team, right? It's not the tech team. And so to be super clear with the SEC about how things work is important to get those comments cleared, because in an IPO process, what happens is you submit your documentation and you get comments on that documentation, and you have to clear those comments in order to get the green light to go public. And that process takes as long as it takes, right? There's no SLA. There's no once you clear this, it's over. The SEC can ask whatever questions it wants or needs to make sure that ultimately your disclosure is clear to investors. And so if it's not clear to them, their view is it's not clear to investors. And that process does require a lot of my involvement.
Awesome. So Michael, maybe last question from me. So we always ask every episode for our guests, high stakes hot take. But I'm curious, what's the conviction or insight guiding your decisions today at Figure that most people in finance will disagree with?
I think most people in finance broadly are focused on AI as the largest opportunity. And I think blockchain is the largest opportunity in finance. So when you think about the future of finance, I think most boards today are thinking, well, how do we prepare for an AI world? And I think they should be saying, how do we prepare for a blockchain world?
That's excellent. I would say that stable coins and blockchain are going to do to fintech what AI did to SaaS. And
Exactly.
I think that that's a very good way and place to wrap it. So let's park it there. Michael Tannenbaum, CEO of Figure. Michael, thank you for coming on, and we look forward to having you on again soon.
Thanks for having me.
Absolutely. That's a wrap on High Stakes, the podcast where Web3 meets the real world. For more insight into how blockchain and AI are reshaping institutions, head to validationcloud.io and follow @validationcloud across all socials. Stay tuned for more conversations from the front lines of innovation. I'm Alex Nwaka. See you next time.